Good day, everyone. Well, it was shaping up to be another Christmas crash as markets looked poised to retest prior lows on last Thursday and Friday, and that was just before the Thursday and Friday before Christmas. Volatility then diminished, and a floor was found as people started to leave work for the long weekend holiday. And nevertheless, Powell has made it clear that rate hikes will continue at least twice more, with any further hikes depending on the data. Now, food and shelter are still running hot, and that's well above the quoted CPI and PCE numbers. The food index climbed 10.6% over last year, and just because inflation starts to drop doesn't mean food is getting any cheaper. It's just not rising in price as quickly. Supply chain disruptions, the conflict in Ukraine, climate change, and transportation costs all are contributing to higher food prices. So meanwhile, rents are going to be renewed into a market where rates are higher than when they were when the original leases were signed, according to the Fed chair. He also said that he sees the rate for new leases coming down, so he believes that once that works its way through the backlog, that inflation will come down sometime this year. Rentals are the largest component of the core CPI, making up 40%. So the upshot is to expect CPI and PCE to stay stubbornly elevated for much of this year, and that will force the Fed to hike by further 25 basis point increments, and the terminal rate will probably be held at elevated levels. Much has been predicted by Goldman Sachs, but the majors should find new lows, while crypto as the ultimate risk on assets should also fall materially further from current levels. Crypto has never been through a recession, and the one that's coming is looking to be historically deep. So, as I've said, it's 10K and pray for Bitcoin, suggesting at least another 50% drop for the altcoins, many of which have already dropped 80 to 90% off their peaks. Now, persistently high inflation will remain above the Fed's target of 2%. This is highly likely. Ray Dalio's view that a revised target of not 2%, but 3 to 4% could become the new norm. The lengthy period of high inflation remains underestimated by many economists. For those who wish to hold bonds, inflation bonds or I bonds are a good bet, as their yields are correlated to inflation. Stock and crypto valuations don't reflect the extreme macro picture as of yet, so markets have not yet reached a major bottom, and with at least 2 more rate hikes on the way, bond yields are bouncing higher. Goldman Sachs believes that the terminal rate will reach 500 to 525 basis points, which would imply another 3 rate hikes of 25 bips each. But this is a best case scenario, as Goldman did say earlier that further 25 basis point rate hikes could occur beyond these 3, depending on the persistence of high inflation. And that would suggest a terminal rate closer to 6%. But regardless, something key is likely to break in the economy before then, due to record levels of debt, and that would force the Fed to pivot. So until the yield curve normalizes, bonds of shorter duration are paying higher yields, and even the 3-month is paying 4.27% versus the 3-year, which is paying 3.85%. Supply side inflation remains stubbornly high due to supply chain issues caused in part from COVID and also in part from geopolitical tensions. Worker shortages are becoming standard as the population ages. And also you got net zero carbon emissions, which are often uneconomic, so they're a significant part of inflation. All these factors could trigger a wage inflation price spiral. The Fed has no tools to deal with this, so are left with no choice but to fight inflation by raising rates to lower demand. And that would deal a serious blow to the economy, so expect the recession to be deep and long. And to add fuel to the fire, earnings expectations have not yet caught up with the macro picture. They are not yet pricing in even a mild recession. But at some point, the Fed is going to pivot by halting, then lowering rates. But that, as I've written before, that doesn't guarantee a major bottom or the start of a new bull. And we saw that the Fed stopped hiking, for example, in 1930. But it wasn't until June of 1932, when the Fed had lowered rates a number of times, that the markets really found the major low. And same happened in 2000 to 2002. These were periods where markets just kept tanking, regardless of the Fed reducing rates. And these were two periods of major bubbles that had to be unwound. And we're currently sitting on one of the largest bubbles in history. So I think that the market carnage could be equivalent to these past two cases when the NASDAQ lost 78% and the Dow lost 90%. That was back in the early 1930s. Goldman says that this cycle is different from the 1970s when inflation got out of hand for a number of years because at present wage growth has slowed and excess savings is dropping. So they think that unemployment will only go up 0.5% in the current cycle instead of the normal soaring rates of unemployment that we see in prior recessions. Now, in agreement, BlackRock says that due to the aging population, the number of people looking for work continues to decline. Plus, many who left the workforce during COVID have not returned. But that's going to keep inflation elevated due to the lower supply of people to employ, and that's going to push the Fed to over-tighten. Goldman, in contrast to BlackRock, assumes the U.S. will avoid recession because GDP will remain just above 0%. In contrast, BlackRock assumes GDP will fall below 0%. By a substantial amount due to the Fed being forced to over-tighten due to persistent inflation. Goldman goes on to write that this cycle is different from the 70s because supply chains are normalizing, inventories are soaring, and the cost of shelter will fall. This will eventually bring inflation down, but not for at least the first half of 2023, as Goldman admits to the stubborn nature of high food and rental prices. This is another reason the Fed is likely to over-tighten, so expect a deep recession before recovery. But that said, Fed officials have noted that they are focused on more leading indicators such as asking rents on new leases, which have slowed sharply in recent months, and that compared to existing rents. So perhaps that might temper how far the Fed over-tightens. Over in Europe, Goldman says that, well, Europe and the UK are probably in recession due to the dramatic increase in household energy bills. And this will boost inflation to 12% in Europe and 11% in the UK. And that, of course, impacts real income consumption and industrial production. So expect GDP to drop below zero in Europe and at minus 1.2% in the UK for this year. But Goldman underestimates the persistence of high inflation, and that's going to cause the ECB and the Bank of England to likely over-tighten. But in any event, a number of things can go wrong as rates are hiked, and that could force the unleashing of a new round of QE. And so whether markets head lower as they did in the early 30s or the early 2000s, or perhaps they move sideways, or as a third alternative, we start into a new bull. Of course, any of these scenarios depends on the magnitude of QE that gets unleashed, and that will depend on the magnitude of the black swan. But we don't know what we don't know. And I would lead by saying that perhaps the black swans should be called hawks because they are circling. Gil, how are you seeing everything?
Yeah, I would agree with all that. I also think that the Fed will achieve a crash landing, and this talk of a soft landing. I often am amused at how all these pundits and commentators on financial cable TV talk about a soft landing as if it's in the bag. And the reality is we already know that the Fed has no idea what they're doing. They proved that when they sat there and told us throughout 2021 that inflation was transitory. And then once we came into 2022 and they realized it wasn't, they had to hike rates faster than they ever have. That is right, Chris, isn't it? That the Fed has never had this many three-quarter point interest rate increases in history, right?
This is a record. I think anything that comes close to that would be in late 70s, but late 70s were different because rates were already very high, and then Volcker stepped in and jacked the rates way up. But that was already from a high level of rates of interest. From historically, we've never come from zero to where we are right now, and that's a huge shock to the system. Yeah. I mean, different to go from, say, if you're at 5% and you go up to 10%. That's not as much of a shock as going from 0 to 4%.
Yeah, so that's where we're at. So we think that the Fed is going to have to reverse policy sometime during the year, maybe sooner than later. But I think the key here is to watch the clues, and I think one major clue here has been the performance of gold and silver, and this is pretty much the trade that we've been talking about, and the only one we've been talking about on the long side as far as anything that's trending and anything that makes sense from a thematic standpoint. And I think the fact that the U.S. froze Russian dollar reserves was a clear signal to a lot of countries in the world that having reserves in dollars for the purposes of trade, maybe it's not such a good idea. And using the dollar as the reserve currency for trade is maybe not such a good idea. And so you've got the Eurasian Economic Union, you've got the BRICS, you've got other countries in the Middle East like Turkey, Iran, Pakistan, etc. Even Saudi Arabia is now talking about trading in rubles and yuan, and also you have countries like Ghana talking about they're only going to buy oil now in gold, and so that's what's happening. And I think you've seen big purchases of gold from all the central banks, and I guess that's where they're headed. I think eventually this whole crypto thing is going to be resolved with a new type of cryptocurrency that's going to somehow be linked to a basket of commodities. Now, I'm just speculating, but I think when you think about it, that's what makes the most sense in the near term in terms of generating confidence in any new type of cryptocurrency. Hopefully it would be outside the purview of any government, but we'll see how this plays out. In the meantime, I think there are two dynamics potentially working against the dollar. And the first one is the market's realization that the Fed may be closer to a crash landing than not. And so you've had this decline since late September in the dollar, and you're still hovering around the lows. So you have not really had much of a rally. You had one yesterday, but that hasn't gone anywhere. Meanwhile, here comes the 10-year yield is backing down back below its 50-day moving average. So we're getting back to this possibility of lower rates, lower dollar based on what the market is seeing. Now, the other dynamic is against the dollar, that working against the dollar is this thing that I just said, where you have other countries coming together to figure out what sorts of new currencies or whether they create a new currency in lieu of using the dollar and this dollar hegemony that's been going on for so long, and which has essentially allowed the U.S. to export inflation and finance absurd deficit spending. So another 1.7 trillion out the window last week, as if it's no big deal. And as Chris pointed out, the Fed cannot let rates go too high because you cannot finance the debt at 5-6%. So something's got to give. And our bet is that the Fed is going to capitulate at some point. And when that happens, the dollar tanks. And also, if you have the continuing trend towards the removal of the dollar as the global reserve currency for trade, that's a disastrous thing for the dollar if it occurs. And if it occurs, then I think hard assets in general, commodities, the higher quality cryptocurrencies, currencies like Bitcoin, Ethereum, probably do very well in dollar terms. Okay, and of course, right now you've got gold and silver in very clear uptrends over the past 10 weeks. I think it is. I got that right. Yeah. So you can see gold coming back up and is now above where it closed 2021, whereas silver on the SLV has closed slightly higher in 2022 versus 2021 and is continuing to trend higher. So, we've liked this trade. We picked up the signals down near the lows, and they've been trending very well. So, if you needed to be long anything, which is, arguable in this particular environment, which is so crazy, this has been the one place to be. And I think there are some good alternatives too. If you like PHYS and the PSLV, these are convertible theoretically into gold and silver. I think though the silver is 10,000 ounce bars they convert, so you got to have enough shares for that. Otherwise, you'd end up pooling and selling to somebody who would then convert it, who'd have the size to convert it. But I would read the prospectuses here. I also like the Aberdeen silver shares, which is another physically backed ETF for silver, and then OUNZ, OUNZ, VanEck, Merck Gold Trust is another physically backed gold ETF, and these are working well. I mean, you can see it. So there's really nothing to say here other than that you have had a nice trend in these, and it's been working. And that's been the trade from the long side that I've pretty much been all over. More recently, you had gap up moves yesterday and pocket pivots in a number of gold miners, and we sent out a report yesterday on that. And you see, it's not very often that you see a strong move on one day. So in other words, Agnico Eagle has a pocket pivot yesterday, and then it gaps up again today, and it's actually on track. If the volume level holds up, you can see that's well about 200% above average. Right now we're running 78.6% above average for this time of day. So you're running enough volume for a viable gap up. We'll see if it holds up. But, you get the gap up pocket pivot yesterday, not enough volume for a viable gap up. But now today you're pushing higher in a clean breakout on big volume. So, you got First Majestic. The silvers have lagged, and I think there's a little tug of war going on there, because silver, half of it is used for industrial purposes. And so if we're going into a severe recession, that's sort of a counterweight. Meanwhile, you've got the monetary thing, which I think in the end will prevail. And especially if the Fed reverses course, you'll see the silvers come back up, because silver's been leading, but it's been better to be in silver using either one of those ETFs I'm talking about or the AGQ if you want to use a leverage silver ETF, because the silver miners have lagged. While the gold miners, you have Anglo Gold Ashanti is a big leader, and I've been talking about this one for weeks now, and probably the most leveraged to the price of gold based on their cost structure. Barrick Gold, look at that, gapping up through the 200-day line. It looks like a viable gap up. Here's Buenaventura Mines, a Mexican, or I'm sorry, it's Peruvian, I think. Let me check real quick. We'll look at the report. In Peru, yes. And support off the 50-day line, but basically hovering around, on top of this structure back over here. So you had this little base structure pulled back to the top of that. Now it's heading higher. So some of these names look interesting just from the standpoint that they haven't started to move yet. Not that they necessarily have to, but I would expect that if the developments we think are occurring with the dollar and the Fed do play out in 2023, then I think this is a place to be, and silver will move along with gold. In fact, silver has been leading gold in terms of the metals themselves. So the miners right now, you got the gold miners in control. Eldorado Gold is a strong, small gold miner. They have a project in Skouries, Greece, where they just got the go-ahead to begin development of that mine, and in a big way. And they also got financing for it, $772 million, I think it was. But that mine, and they have a number of properties around the world. I always try to go, dig into some of these and their financials and figure out just how leveraged they are to the price of gold and what their mines look like in the years of production that they have left. So fun stuff like that. And I'm a bit of a mining nerd, so I'm into it. Your average person would probably just say, oh, this sucks. They don't want to deal with it. But I get into it. Ever since we went to Knott's Berry Farm when I was probably 3 or 4, and then a couple of years later, I decided I was going to start digging a mine shaft in my parents' backyard. And my friends and I, we got about 3 feet down in our shaft, building our shaft before my mom, as we put it at the time, shut down our mining operations. But in any case, I've been into it ever since, and I find it very interesting. And so, for me, looking at these gold miners and silver miners and what they produce and where they produce it and how much they produce and for how long and what their cost structures look like, it's all very interesting to me. So I can tell you, I have a pretty good grasp of where most of these miners sit. Eldorado Gold, once they bring that Skouries project online, you got a $225 million in free cash flow per year. So one thing you need to understand about the mining business is the better your cash flow, the better the business. So a lot of companies, like, for example, First Majestic, they're negative cash flow. And I thought maybe that's one of the reasons why it's a laggard. But I do like the Ego, not only because the symbol is probably, as my wife says, is very appropriate for me. And I can't understand why, but in any case, other names like Franco-Nevada regaining the 200-day line, it's going to move higher with gold. They own production streams. Goldfield is one I've been on for a while. It basically formed a very nice, look at the Kilpatrick chart. I mean, this is a pretty nice little mini double bottom type base, and boom, here you go. And you're starting to break out, and the volume looks pretty good. So That's been one of my favorite names in the group for a while, and there it goes. So we're not enough volume right now on the projected levels for a viable gap up, but acting very well. If you weren't looking at other things in the market, you might think that we're in a bull phase. And with suddenly these miners are moving. Barrick Gold gapping through the 200-day line. I think I already showed you that one. Mag Silver is a high quality junior silver miner. They've got a new project in one is Scipio in Mexico that's coming online, and positive cash flow. They expect to be very strong, positive cash flow or cash flow positive in 2023. So sitting in a base, nothing terribly exciting here, but you use the weakness to accumulate if you want to play in this space. And I think, this is already proven out to be a place to be. The structures, the chart structures, the consolidations, the pullbacks, everything has been very constructive and held up pretty well. Now they're starting to move again. What is that telling us, if anything? The Cisco Gold Royalties, I like this one. It's a Canadian owner of precious metals production streams, mostly gold. And you can see that bounce off the 50-day line on Friday. And you're working on a pocket pivot today off of the 10 and the 20-day moving average. Pan American Silver posted a pocket pivot at the 10-day line yesterday, and you're starting to break out of this range that you've been in for quite a while. So coming out here, there's Sprott Physical, Silver Trust, and Gold Trust. Royal Gold is another one, another big miner. I was interested to see that you had Agnico Eagle, which is a favorite among hedge funds, Newmont Corp, Anglo Gold Ashanti, which is another institutional favorite. Newmont is an institutional favorite. Royal Gold is another favorite of hedge funds. And these are the ones that are suddenly moving, which tells me there must be some institutional interest suddenly in this space. And they've been setting up for a while. So acting very well. You've got a potential viable gap up here based on the projected volume levels. You're at 91.4% above average for this time of the day. So let's go and look at some other stuff. And as I was saying, if you do get this crash landing Fed reversal thing, and you do see the dollar come under pressure as the global reserve currency, then it's going to be positive for anything that is either commodity or alternative currency related. And we'll just see how this plays out. I know a lot of people right now, everywhere you look, everybody hates crypto, which maybe that's a good thing for crypto. But I'm not going to pass judgment on anything. I think if cryptos are valid and usable alternative currencies, then if the dollar gets into a lot of trouble, their value is going to go up in dollar terms. End of story. So unless they're absolute garbage and worth nothing, which I suppose is a potential outcome too. But I'm just going to let it play out. I'm not going to judge. Anything. I'm not going to come to any judgment about where it should be or what it is and what it isn't. I can only tell you what it is right now. Right now it's trending lower, crypto is, whereas the precious metals are trending higher. And I certainly don't take the position of these gold bugs who've been telling you we're going to have gold 10,000 for the past 50 years. All I know is that it looks like we're heading higher right now. Anyways, if I look at my daily notes, these are positive names I looked at on my screens this morning about, say, an hour ago that were looking positive. Of course, the golds are in there. Boeing is moving higher, which I think is interesting. Eldorado Gold, Goldfields, we talked about that. Barrick Gold, these are all the golds. Iridium tried to break out yesterday and failed. It's re-breaking out today. Very interesting. The home builders are acting well. Now, here's another clue, okay? If home builders are sensitive to interest rates, and interest rates are going higher, theoretically, why are they rallying? And why do they continue to rally? And they act constructively, even though all the data is pretty poor right now in the housing industry, both existing home sales and new home sales. But yet these are setting up, they're basing and moving higher, basing and moving higher. If you're interested in buying this group, then you want to buy it as close to moving average support as possible, and then use that as you would with the gold miners and silver miners. You use that as your selling guide. The tighter, the better, because you never know what's going to happen in this market. Look at this. Now we're rallying. The Dow's up 66, 67, the NASDAQ up 29. I'm actually long Tech L right now, which I went long a little while ago on a 620 turn. I'll show you that in a second, hopefully if I don't forget. If anybody has any questions, feel free to ask. I noticed Las Vegas Sands, also Wynn Resorts. These are both rallying, and that could be related to the fact that now China has completely reversed their position on zero COVID to COVID zero. If you catch my drift, basically they don't want to have any COVID cases, and if you test positive, they shut you away in your apartment building for the next however long they want to keep you there. But now, whether you test positive for COVID or not, it has zero effect on your ability to go to work now, I suppose. So that's why we've gone from zero COVID to COVID zero in China. And that may be opening up some of the resorts out there that these companies run, possibly, that Wynn and Las Vegas Sands run. Raytheon, just looking like it might want to go higher. SSR Mining, that's another junior miner, doing well, punching up into the 200-day line. Wheaton Precious Metals pushing higher. Wynn Resorts breaking out, so that's just like Las Vegas Sands. I noticed XPeng, which is XPEV, which is a Chinese electric vehicle makers, working on a pocket pivot today. It actually posted, I think, a 5-day pocket pivot yesterday at the 10-day and the 20-day, but it's stalled, as you can see. And then today you're pushing higher on projected volume that would be enough for a pocket pivot. So, those are some interesting things on the long side. If I go to my short notes, I can see things like Array is pushing in. This is a solar. They make solar platforms that turn with the sun, so they keep the solar panel perfectly at a 90-degree angle to the sun, perfectly perpendicular. And you look like you're pushing up into the 50-day line where it's shortable. Bungie was shortable yesterday as it busted, excuse me, where it busted the 50-day line. And now I'm watching this rally, see if maybe it doesn't come back up. So let's see if this is, yeah, okay. So here we have Peabody Energy. China, it's been coming down. This has been a short I've been working over the past week, and now it looks like it's a shakeout at the 200-day line, so that's a cover point. I'm looking at CSX, possibly a short here just below the 20-day line. Corteva, short below the 200. CSX, wait, what happened here? Deere and Company, support off the 50-day line. Now, it was a short at the 20-day line last week, but now you're undercutting this low here, so you have an undercut and rally move going on through this low, and you're finding support at the 50-day line. So it's possible that could play out as a long. I know that CAT has been acting very well. It's holding tight along the 10-day line. You look at stuff like Solar Edge. Shortable at the 20-day line last week when it broke the line, and now you're running up into the 20-day line. I don't know if that brings it back into short sale range. Look at some of this semiconductors like Kulicke and Sofo, which is a semiconductor equipment manufacturer, pushing up into the 50-day line. I'm watching to see if that perhaps brings it up into short sale range. UPS pushing up just above the 50-day line, possibly. Watching AMD, some of the semiconductors. I actually played the SOX S this morning briefly, and I got a nice 2-point pop out of it and then blew it out. And like I said, right now I'm along the Tech L. AMD, not really anything there. Let's look at something like Rambus. Where's that B? There it is. Possibly short at the 50-day line. Mostly looks like it's just in a long base. So it could rally back above that. McDonald's reversing along the 10-day and the 65-day today. So that triggered as a short when it busted the 20-day line over 2 weeks ago. So that's where that one is now. Some other names here that possibly on the short side might be setting up. I was looking at LRCX, trying to push up into the 20-day line where it's stalled. But it looks like the market wants to rally. So, like I said, I'm long the Tech Al here. I'm also long gold, trading the gold and silver ETFs. So right now I've just got the gold ETF. And gold continues to hold up. It's up 1670 today. We're at 1862.80 per ounce on the futures. What else? What else? I noticed. Now I was talking about how home builders were pretty strong, but Beazer Homes is running right into the 200-day line. Volume is running 52.3% below average for this time of the day. So that's kind of a voodoo type pullback or push up rally into the moving average, and that may turn out to be shortable. So we'll see. Global payments pushing into the 50-day line where it's stalling. Notice how you've had this low volume rally. And basically, you do get this undercut and rally down here along this low, and so that generates this rally, and that makes sense. But basically, overall, you're in a bear flag. You're pushing to the highs of the bear flag, and you're running into the 50-day line and stalling along the line. So, yeah, it looks like we're getting going pretty nicely now. We're up 167. Was there some news that came out, Chris? You see anything?
I haven't seen anything. No, I think it's just that the markets are volatile and they're also maybe knee-jerk on the Fed minutes. I know in the past, Fed minutes, this is usually old news, and markets don't really react too much to the minutes. So I mean, I think we did have one negative reaction. There was something in the Fed minutes that was different from what Powell was saying. And I think that was earlier this year, but normally he sticks to the script. And so I don't expect the Fed minutes to be that consequential. But that said, we have the jobs report on Friday. And given what Goldman and BlackRock have said, I mean, I've been saying too that, you have a lot of the workforce that's retiring. And then you also have people who left the workforce during COVID that did not return. So there's not a lot of supply out there. That's why I think the unemployment rate has stayed stubbornly low. I think the last report was 3.7%, and it could still maintain it. I mean, Goldman thinks it's only going to rise by 0.5% into this year, which is really going against the prior recessions where unemployment soars. But this is a different situation, which, I admit, this is a different can of worms. So because of COVID, because of the aging of population, the demographics clearly are different now than they were before. And I think that keeps demand pretty tight. And again, that's going to cause potential wage inflation. There's not enough supply of workers out there. The job postings continue to, creep higher and higher because they're not getting filled. So I think that's going to be a vital part of the inflationary equation. So Friday's number, in other words, could be strong once again. The unemployment could once again be 3.7, 3.8%. And I think that would scare the markets. I think we could see a drop in markets as a consequence of a strong jobs report because it means the Fed has to keep hiking rates.
So what was my question? I already forgot it. You went on.
Well, it was I wanted to talk about what I see in terms of the upcoming report.
Anyways,
you want to know why the markets are rallying, and there's no news. I think it's just
there's nothing.
The Fed minutes.
Yeah, that was my question. Now I remember. Okay.
Right. But I wanted to definitely hit on, it was a great segue so I could talk about the Friday jobs report because I think it could be nasty.
That's right. We do have the jobs report. Probably be a key one, perhaps. But some other names. Uber looks like a short at the 20-day line. Texas Instruments looks like a short at the 200-day line. Sprout Social, man, that already reversed. I saw that pushing up here into the 200-day line in the 50 this morning, and now it's completely reversed. Roblox looks like a short along the 20-day line. Skyworks Solutions, let's see, hanging along the 50, not really much there. ServiceNow pushing into the 50-day line. 3M pushing into the 50-day line. Basically just screening for low volume rallies into resistance. KLAC just kind of hanging along the 20-day line, but it's above the line right now. Home Depot pushing above the 20-day line. These may not roll over. Like I said, if the market continues to rally here, which it is, then something like an Activision Blizzard, for example, it's in a double top formation along this high, right? So if you went above this high and then reverse back below it, that would trigger a short sale entry. And I believe that the high right there is 77.55. Right now we're trading at 77.14, and you're just above the 200-day line. So you could set up as a short in one of two ways. You either go above this peak here and the 77.55 high, and then you reverse back below it. That would trigger a double top short sale entry. If it reverses back to the 200-day line, either before or after that, if it occurred afterwards, that would be confirmation, right? But if it didn't get through that 77.55 left side high here and just reverse through the 200-day line, that would trigger a short sale entry at that point. So anyways, those are some of the notes I made on the long and the short side this morning. If we look at big stock NASDAQ names, they're not really having too much fun the past couple of days. Apple to lower lows yesterday. It's trying to rally this morning. Amazon trying to hold up. Booking Holdings, I guess moving in sympathy to what you're seeing in Las Vegas Sands and, excuse me for a sec. Las Vegas Sands and Winds. Maybe the whole group is moving. I'll have to take a look at that. But geez, Cisco, along the 20-day line. These have been under pressure. And you can also make an argument. Look at Microsoft. I was new, and I don't see any news for this either. When I saw that news, and that created this rally into the 200-day line about 3 weeks ago, that they are going to take a 4% stake in the London Stock Exchange. It's typical news when you have a big leading stock. It's been a leader for a long time. And then they begin to diversify their business away from their core businesses. And I don't understand what running or having a stake in the London Stock Exchange has to do with Microsoft's business. If anybody can figure that out, let me know. But not looking like much anything here as it gaps lower. So I don't know. You could treat that as a shortable gap down, but if the market continues higher, then it probably turns. Like you see, Netflix was a short along the 20-day line last week. Now it's pushing back to the upside, and you look like let's see, 1, 2, 3, 4, 5. If you hold volume levels here, that would be a pocket pivot at the 20-day line. Some of the semis are just sitting in bear flags, like NVIDIA. That's a big NASDAQ name. Oracle pushing back to the other prior highs. Qualcomm just kind of ugly. Tesla, massive dog, but it's a car company, they make cars, and just like everybody else. So, people, well, it's cheap now. Well, 33 times trailing 12. If you look at something like Ford, 7.21 times trailing 12. And so I have to think that at some point Tesla comes down to a 10, 15 P, unless, of course, the Fed takes rates back to zero, then all bets are off and everything goes nuts. But that's basically what we're seeing. I said I'd look at the travel industry. We can look at, say, Booking is doing well today. Avis Budget just trying to come up off the lows. Carnival trying to come up in a pocket pivot move off the 10 and through the 20. Walt Disney trying to come up off the lows. Hawaiian Holdings. These are some of the airlines got hit. So I don't really see anything here. Here's Lyft, not really anything there. Marriott, just trying to rally off the lows. Royal Caribbean, same thing. SeaWorld, pushing back to double top highs. Six Flags, pushing for the 200-day line. But overall, nothing really too exciting here. But they got the market going now. Dow's up 207. So I think I've given you a pretty good overview of what's out there today to start the year off on the second trading day of 2023. And perhaps some things to keep an eye on. You can build your own watch list from some of the ideas I put out here. And could be long or short. Now, what I'm doing here, last year I spent a lot of time trying to trade volatility, because my theory was that UVXY would have a big spike during the year as we were in a bear market. And if you notice, this vehicle itself just trended lower all year long. So there you go. So, I had one account where I was just trying to trade this, and day trade or short-term trade, that was a disaster. It didn't work at all. And so I think, and I've been reading about this for the last couple, 3 months, is that the way options trading goes on now, and the types of algos that trade in options, and also the this movement towards what they call zero DE or ZDE, a 0 days to expiration, where you get huge option activity just before expiration one way or the other. This skews the VIX and goofs it up, I guess, because the VIX has pretty much been in a sideways pattern all year long. It's just been choppy. It goes from around 1920 up to 35, 36, 37, and back down. So there's no big spike, that you saw back at the very beginning of 2022 when the Fed first started raising rates, and these other big spikes that were pretty sizable. So you never really got anything terribly huge, some playable moves, but nothing really that big. So this year I want to try something a little different. And so I'm playing pairs, Tech L, Tech S, SOX L, SOX S, and I will basically track these on the 620 charts. And so this morning I can be long the SOX S off of this turn, get a nice trade out of it. And then when it reverses, go long the SOX L, bail out of the SOX S, buy the SOX L. Same thing with the Tech L. I actually this morning bought it off the lows. I was actually, first I played the Tech S, okay. And at the open we had a rally. We had a little move here and the MACD cross early in the day, so we're able to come in like 41, 41.25 around in there, and boom, get a nice point or so out of it, and then it rolls back on the MACD, so flip out of that and go long the Tech L. And that's basically what I'm doing. And if you want to stay busy, it's a good way to stay busy. But I think we're going to be in a volatile environment here as the market figures out what the Fed is going to do next. And whether they're going to, and this is the key thing in my view, is whether they're going to engineer a soft landing, which I think is, the long shot trade here, or they're going to have to respond to a crash landing by reversing policy very quickly, and possibly, as Chris was saying earlier, a black swan event. What that would be exactly, who knows? But, that could be the catalyst. So I think that's the thing that we want to be watching for this year. And also we have a pretty strong theme in the precious metal space that is working right now. And it's been the only long theme. I guess we could have created a focus list out of the miners, but didn't really seem like it made that much sense given the propensity for things to change very quickly. But I think you'll have a volatile year in 2023. And so this strategy is something I've come up with studying what I did last year when it comes to my ETF trading, what worked, what didn't work, and taking it from there and trying something out a little different this year. Anyways, that's all I've got. You got anything else to add, Chris?
I was going to add that credit debt is soaring because of these programs in the United States of buy now, pay later at 0% rates of interest. And so that's another bubble that is brewing, and that could also, be the straw that forces the Fed to start to helicopter money into all these people who might not be able to pay their credit cards and their debt off because of all the buying that's been going on at 0 rates of interest.
Yeah, good point. Anyways, so that's it for now. We'll catch you guys next week, and we'll just see how things go. You get the Fed minutes this afternoon, and you get the jobs number on Friday, probably, but not necessarily, but probably have some effect on the market, and we'll just have to see how that plays out. But I think we've given you a pretty good idea of what's out there, the lay of the land, and where opportunities might lie for now. Anyways, thanks for showing up. We'll catch you guys next week. Take care.
So long, everyone.